Things you can do in 15 minutes. Walk the dog. Make a smoothie. Meditate. Now you can add creating a personalized retirement plan to that list. Schedule your complimentary 15-minute call with Heckman Financial Services today. Text VISIT to 800-454-1184.
Keyword.
That's VISIT to 800-454-1184.
Most people who are near retirement haven't met with a financial advisor, and that could be a costly mistake. So today, Eric is here to tell you about some of the questions to help you ask the right financial professional. Thank you so much for joining us. This is Wealth Creator Radio with Eric Heckman. Here is the phone number for you to remember for today's show, 800-454-1184. 800-454-1184. You can find us online anytime at wealthcreatorradio.com. Another thing you can do is get the Wealth Creator Toolbox. All you have to do is text the word toolbox, and there's all kinds of materials in it, lots of things that you can choose from. It's basically a digital toolbox, and we'll be talking about it more during our show. Thank you so much for joining us. Eric, great to be here with you.
Yeah, Luann, it's definitely a good topic to be talking about is, do you need to be meeting with somebody? What's a good time to do that? And, and why is it important, right?
Exactly. So I have a recent survey here that says of Americans about 55 and up, it's pretty revealing about our preparation for retirement as a nation. Only 27% of the respondents said that they're confident their savings is going to last as long as they live. 60% don't feel like they have enough money saved. 67% have not met with an advisor to create a retirement strategy. What's wrong with this picture?
Wow, I know, isn't that? I think that's actually said incorrectly. 27% said they're confident, so we really should be saying 73% of people. They don't think they're going to do good in retirement. They think they're going to fail. Okay, if you've got some gash that's bleeding out your, arm or something, right? You go to the doctor, you go to the ER, you go someplace to try to get that fixed. If you think you've 67% of people have not met with anybody, but yet 73% of people think that they're going to fail in retirement, and yet they're not talking to anybody about this. And, so it really makes no sense because, this survey also, as you said, was for people 55 and up. So, if you're talking about people that are, in the retirement red zone, these are people who are about to retire. They're that worried about all the situation, geez, time to sit down and get some help, right? It's kind of crazy. It's just like you're going to refuse to look at the map or the GPS, and you're just going to keep heading straight and
blindly.
Blindly. And at some point that may not work out. So, right. I think a lot of people really need to sit down and meet with somebody.
Three-fourths of us who are heading that way, not yet thinking that they're going to have a good retirement. And there used to be a promo, Eric, called The More You Know. I remember watching that on television. Obviously, when we have knowledge and we have clarity about what our retirement is going to look like, then we're going to feel more confident, right? So tell us how working with a financial professional like you can help us feel more confident about our retirement.
Well, yeah. Really what you have to do is you have to have an income strategy. That's the kind of the biggest key is, having the knowledge of where that money is going to come from. Once you stop having a normal paycheck, you got to create your own paycheck, right? And if you don't have that paycheck, or if you don't know how long that paycheck's going to last, don't know where it's going to come from, you need to do some work. You need to sit down with somebody and say, hey, show me an income plan, a written income plan, one that shows me how my money's going to do for the rest of my life, and then is it going to last or not? And if it's not, well, when do you want to know? Before or after you run out of money, right? So way before, hopefully, because then you have time to change things, right? You could change some assumptions. Maybe you move, maybe you work longer. There's lots of different things you can do. And so that's what we do is when we take somebody through that blueprint to worry less wealth, so that way they don't have to worry and they don't have to be in those 73% of people that are basically worried daily if they're going to survive their retirement. then if we can take you through that process, it's going to get you a lot more education, a lot more knowledge. So one of the things we built here was the toolbox. And this toolbox, it's not not one with a handle or anything like that on it. It's got some great stuff in there. It's got empowering women investors, how to make sure money lasts as long as you do, see if you're paying too much in taxes, Social Security issues. It even has a couple copies of my book, Worry Less Wealth, a couple chapters there. And so these are things that you want. You want to be able to get these. And again, these are all digital resources that are free to you to grab and download and really educate yourself. If you want to go beyond that, you could actually set up a time there too. So, if you do want to get that toolbox, all you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or go directly online to wealthcreatorradio.com.
And we just thank you so much for joining us today. So happy to have you along with us as we're learning more about, how to create wealth in retirement from Eric, founder of Heckman Financial right here in the Silicon Valley area. And you're listening to Wealth Creator Radio. I'm Lou Ann Fulmer. So for people who don't have a retirement advisor, let's go over some potential questions maybe that we should be asking to try to get that right fit. So as I'm looking at these, Eric, there's like 10 questions, okay? I'm going to kind of let you take them. Tell us what are some questions that we need to be asking.
Well, I mean, if you're trying to interview a financial advisor and find out, what they're going to do for you, you want to make sure they're actually, first of all, even able to do financial planning. So are they a certified financial planner? Are they a registered investment advisor? Do they actually have some sort of designation that allows them to do this? A lot of people are just investment managers. I mean, the Vanguards and Fidelities of the world, they'll have some sort of software, but they're not going to really help you per se to, walk you through everything. They'll just say, hey, here's the software. Here's what the software told us. That's not exactly a plan. It might give you a little bit of clarity, but, really want to see, okay, how do they incorporate taxes? How do they do Roth conversions? How are they figuring out what to do? And then how do they get paid? Charge a fee, or is it all up front, or is it all open and honest? What are the other things that they do with their clients? And obviously, how often do they meet with them, right? So is it going to be just once a year? Is it every 6 months? And then are there other things that they should be focusing on, like at certain times of the year, like maybe doing Roth conversions at the end of the year, obviously tax planning at the beginning of the year. So there's a lot of things to be thinking about and asking. So you want to really find out what their process is. Is it, pretty easy and pretty simple? Then you want to check them out. I mean, one of the tools that we have on our main website is actually a way to check out any advisor. And it's got all the different links to the different places that advisors have to report to. And so that way you can see if, do they have some complaints? Do they have problems in their past and things? Because again, just like a contractor, just like a doctor, anybody, you want to make sure they know what they're doing. And if you're going to hire them to work with your life savings, you got to make sure that it's the right person for you. Yeah,
pretty important. Is there anything missing from this list that you think should be here?
Well, I think probably the biggest thing is, obviously one thing is, ask for references and referrals. A lot of places, like I'm not allowed to give them out until people ask me, which is just silly regulations.
Oh, interesting.
But,
okay.
So that'd be one thing to look at. But the other one is, do they actually have their own process that they've created? Is it some sort of differentiated process? Because if they're just following somebody else's process, then they may not necessarily know if that process works or not. Have they been in business long enough? For us being here 30 years, over 30 years now, I should say, but we've helped people go through that whole retirement process, and we've got to see firsthand what works and how it works, and what things to improve upon. So again, you want to make sure it's somebody who knows what they're doing, has a process, and again, that's why we created the blueprint to Worry Less Wealth. And if that's something that you would want to get a little bit more information on, you can set up a 15 to 30 minute phone call. All you have to do is text the word visit to 800-454-1184. Again, text the word visit, 800-454-1184, or go online and book it directly at wealthcreatorradio.com.
This is Wealth Creator Radio with Eric Heckman. We're not done yet. We'll be right back.
If something's worth doing, it's worth doing right. There's a particular time of life this phrase couldn't be more appropriate. How can you know you'll live the retirement you've always imagined? After all, life can be so unpredictable. You've worked hard and saved. Watch your accounts go up and down with the market. Your advisor says, don't worry, you'll be fine. But you still don't feel confident. Eric Heckman at Heckman Financial has a checklist to help you find out if you're on the right track for retirement. Take his checklist challenge. If you can check all the boxes with confidence, you may be ready for retirement. If not, Eric can help you address any potential costly mistakes. To get Eric Heckman at Heckman Financial's complimentary checklist, call or text LIST to 800-454-1184. See if you've got it right. Take the checklist challenge today. Call or text LIST to 800-454-1184. Firm offers insurance services. Investment advisory services offered through Heckman Financial and Insurance Services, Inc. Investing involves risk, including the potential loss of principal.
Hi, you're listening to Wealth Creator Radio with Eric Heckman, president of Heckman Financial, and he is here to guide you about retirement and finding that wealth that you need in retirement, having that successful retirement. You know, when you think about it, there are so many moving parts when it comes to preparing for retirement. When should I take my Social Security? When might I accidentally trigger higher taxes? Or what if I make a wrong move with my retirement savings? And there are so many decisions that can impact each other, Eric, that you could say that retirement planning is kind of like trying to figure out a Rubik's Cube, right?
Yep, so certainly. And, those things can be tough unless you're a kid and you've got a lot of time to do them.
Well, I was going to say, were you ever any good at them? I would think you would be. You're a smart guy.
I think at one point whenever that was in the 80s, I guess, or something, when they were going, I was able to solve them after a while. But
wow.
I think the neat thing nowadays is people do the artwork out of those. Those are pretty fun to watch. But
oh, really?
Yeah,
I don't know about this. The creative side of it. Okay.
Yep. I mean, it is one of those critical things to know about Social Security and see how that literally does fit in the puzzle of retirement, because it's one of the bigger pieces, and it's one of the ones that if you find out later you did it wrong, nothing you can do about it. So you want to do it right the first time.
Yeah, it's interesting you just brought up Social Security, because I wanted you to give us examples of retirement decisions impacting other areas of our plan. So Social Security.
Yeah, so definitely taking Social Security, at the wrong times can be bad. Probably the biggest one out there is before your full retirement age. So, if you're born 55 to 59, you're some version of 66 in a few months. If you're born 1960 and after, that's 67. But, if you are working or sometimes you say, oh, I'm not going to work. And so you stop working, people turn on Social Security, and then they get a good job offer or somebody recruits them to come back. And then guess what? Oops, hold it. You made too much money. And once you make over about 21 grand, they start taking $1 for every $2 that you make over that amount.
Yikes.
So for most people, once you make about 60, 70 grand, all the Social Security will get paid back, and you'll keep that penalty for starting too soon. That can be a big mess. And so, yeah, you definitely do want to watch that. And, probably the other one that I see a lot of, it's a little bit sneakier, is, is lots of times people will either sell stuff or they'll do a Roth conversion and they're over 65. Well, that shouldn't be a big deal, right? Except for this is what sounds like a nice old lady, Irma. But she's not. So
she's not nice.
So Irma is this calculation for a monthly adjustment to your Medicare premiums. And if you make too much money this year, over around 191, then you might start paying 40%, 100%, up to 240% higher Medicare premiums based on your income. And so again, that's something where this tax thing or that tax thing hits and you did something and it doesn't show up on a tax return. It shows up not right away, but it shows up a lot later. And so that's one of the things that you have to watch out for is that sneaky little Medicare, not a tax, but a Medicare premium increase. It's based off your taxes. So let's just call it a tax.
Right. Yeah, why not, right? So what are some key pieces, let's just go through that again, of a retirement income strategy, and then we'll move from there.
Well, the biggest thing is what do you have coming in on a systematic basis, right? What can you count on? So, obviously Social Security, if you have a pension, if you have any set dollar amounts, if you have any monies guaranteed from an insurance company that's coming in on, a monthly basis. So those are things that kind of give you your baseline pay, right? That's kind of like your main income. And then, most people usually have a gap, and that gap is how much money do you need to make that monthly income that you need. And so that's going to be coming out of wherever else, right? Your investments, your savings. And so, you need to know how much is that fixed amount. And then you need to know how much is going to be coming out from, other sources and which sources those are. And so that's one of the key things that you have to be, really knowing and, having that information, knowing, will your money last? Are you paying too much in tax? Which ones should you take money from? How do you get Social Security? Those are all items that are in our toolbox. And so that's a digital toolbox that's free to download. If you want to get access to that toolbox, it's pretty simple. All you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184. Or you can download it directly at wealthcreatorradio.com.
And again, you're listening to Wealth Creator Radio with Eric Heckman. I'm Lou Ann Fulmer. Eric and his team are here to guide you with all these confusing and questions that we have about retirement. We're all bombarded with. He and his team can explain it to you in a much easier conversation, and they are offering a chance for you to go in and see them. So take them up on this. All right, let's talk more Social Security now, because it is one of the pieces of our retirement income puzzle. Tell us how you help someone decide when it makes sense for them to file. Don't do what your neighbor is doing or someone else at work is doing.
Yeah, well, so one of the worst things out there, and a lot of financial advisors, sadly, even use these type of tools, is that they'll look at these numbers of, hey, if I start Social Security at 70 versus 67 or 65, whatever the, other date is, somewhere in my late 70s, early 80s will be when it would have made more sense to, wait. And so, okay, because of that, I should wait. Well, okay, what's missing there, right? Well, what's your health status? What are your other assets, other things? Are you really going to wait to retire? Or you're talking about just not having any money for quite some time while you're retired? Because you can do that. You don't have to have your Social Security turned on to retire. I find 65 is still the number one age for people to retire, mainly because of Medicare. But lots of times now it's 60 in your 66s or 67 is full retirement age. But what happens to your other assets, right? So if you go to retire and you don't want to turn on that Social Security and say you're going to wait till 67, so that's 2 years of not getting that $2,000 to $3,000 a month. Well, if you add that all up, that could be a lot of money that's now having to be drained out of your other accounts. So the fallacy of that whole let's wait and then here if I waited here versus now is people forget about your other assets. So the only way to ever decide on Social Security is to have it inside an income plan. Because I can tell you easily which way it works for your situation. If you have it inside an income plan, I can say, here, at age 80 or age 90, this is how much money you have. And if you do it this way versus this way, which one gives you more money when you're 80 or 90? Not from Social Security, but overall, in terms of your overall assets. Because if one ate up a bunch of assets and you have almost no money left just to wait to have a bigger Social Security check, and then your car breaks down or your house has a problem and you have no money because you only have his Social Security checks, right?
Yeah.
Yeah, it's not too good. So I find that that's the biggest thing that people need to do is really figure out, how does it go in your income plan? What's the best way to turn on that Social Security?
What do we need to know about other common sources of retirement income other than Social Security, Eric?
Yeah, well, having that Social Security income obviously is a big part of it. Lots of times people say, "Oh, it's not that much." It can be a lot of money, right?
Yeah.
So that's good, but it's not going to be enough. We all know that. And so, say you spend $8,000 a month in retirement, and you've determined with Social Security between you and your spouse you're going to get $5,000. Well, that means you got a gap of $3,000. Well, do you want to just have that all on maybe money? maybe money's like, it may be there, it may not.
Yeah.
You know, that's,
No.
maybe stuff's not the fun way to retire. That's the way to freak out your life, pretty much.
Yeah.
So, you know, we like to have it where there's a little bit more higher confidence. So, you know, if you could add some guaranteed foundational stuff, is that from a bank? Is it from an insurance company? Wherever. But if you know that you've got 1,000, 2,000 more coming in, now you barely have to get any money from your assets. So the market conditions aren't going to be as critical for you, you know, in retirement. But that's the mistake people make, is they don't think about that. And then they retire on this hope, and you hope you hope everything's going to happen, but it may not. And then what happens? Well, you know, there's not many options if you're 85 and almost out of money. So, you know, again, these are things that we need to be thinking about, and, you know, really having a plan, having that written income plan that says, hey, here's, with inflation, with taxes, with everything calculated in, am I going to be okay? And it's easy answer, yes, no, or you'll be okay until this date, right?
Yeah.
But again, at least now we've got time to fix it. So if you want to get some more information, if you want to have some stuff, will your money last as long as you? Well, you know, are you paying too much? Social Security decisions, all these things are great quick reports that we have, really easy to read. They're in our digital toolbox. That's our Wealth Creator toolbox. Again, it's something at no cost to you. All you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or you can download it directly at wealthcreatorradio.com.
How can we keep from accidentally triggering higher taxes in retirement? That's next with Eric when Wealth Creator Radio continues.
If something's worth doing, it's worth doing right. There's a particular time of life this phrase couldn't be more appropriate. How can you know you'll live the retirement you've always imagined? After all, life can be so unpredictable. You've worked hard and saved. Watch your accounts go up and down with the market. Your advisor says, don't worry, you'll be fine. But you still don't feel confident. Eric Heckman at Heckman Financial has a checklist to help you find out if you're on the right track for retirement. Take his checklist challenge. If you can check all the boxes with confidence, you may be ready for retirement. If not, Eric can help you address any potential costly mistakes. To get Eric Heckman at Heckman Financial's complimentary checklist, call or text LIST to 800-454-1184. See if you've got it right. Take the checklist challenge today. Call or text LIST to 800-454-1184. Firm offers insurance services. Investment advisory services offered through Heckman Financial and Insurance Services, Inc. Investing involves risk, including the potential loss of principal.
You're listening to Wealth Creator Radio with Eric Heckman. Eric is offering to help you create a retirement strategy. So many retirees don't have one as they're heading into, you know, a most important time of your life where you're not going to be working anymore. He and his team at Heckman Financial are here to guide you so you can have a remarkable retirement. So we're talking today about how there are so many moving parts when it comes to preparing for retirement, so many decisions that can impact each other. And Eric, you know, you could say that retirement planning is almost like trying to figure out a Rubik's Cube, right?
No, exactly. There's a lot of things going on, a lot of pieces, and a lot of stuff that, a lot of hidden gotchas that you know, those just online calculators and other things aren't smart enough to, you know, to figure out and do. And, you know, so that's why I think people really need help knowing how to navigate to how to get this money back out. It's one thing to have it grow, but taking it back out, there's so many more issues.
Right. And that's why I'm so happy we do this show, just for all of us to learn. When we have knowledge, then we're going to feel better and we'll make better decisions. All right, so we've been talking about, you know, taking Social Security, what we need to be doing to try to claim it at the right time. But for those people who are taking Social Security, they have to start thinking about those required minimum distributions, right? And the impact can be what is sometimes called the tax torpedo. I want you to explain that. How can we keep from accidentally triggering higher taxes?
Yeah, so the tax torpedo is this kind of funky spot in the tax code that Well, first came out in the 80s when they said, oh, we're only going to tax 50% of your Social Security. And then in the 90s, oh, we're going to only tax 85% of your Social Security. It's like, okay, at least I haven't gotten to 100 yet. But one of the super sneaky things they didn't do was they never adjusted any of that for inflation. So whoever was, quote, wealthy in the 90s, that's a couple making $34,000 or 50%, and then $44,000 at 85% of their Social Security, then gets taxed. So what's this tax torpedo? Well, basically what we're talking about there is, say, you got Social Security turned on, you're living on savings initially, so you're almost in a basically zero tax bracket, and then you take out $5,000 to go on vacation out of your IRA. Well, that $5,000 may have now gone from zero tax on your Social Security to being now 50% or even up to 85%. If you took out 10 or 15, for sure it would get you up to 85% of your Social Security being taxed. So that's all of a sudden, if you look at the tax rate, because all that income wasn't taxed and you just took out that little bit of money, and it caused all of your income to be now all of a sudden taxable. That's what they call the tax torpedo. So again, something that you may or may not hit. Maybe you need more money out of it than that, and you're over the Social Security taxation. But a lot of times, if you structure things right, you can actually live at least a few years early on in retirement pretty tax efficiently, if you don't screw up and get hit with a tax torpedo.
Right, that's why we need guidance, So let's talk about how we can have more control over the income taxes that we pay in retirement based on the way we take income from those retirement accounts.
Yeah, really the best way to kind of conceptually do it is think about, you've got 3 different buckets. So lots of times, actually, in my live events that we do, I'll actually bring out some buckets, and think of the 3 types as: one's taxable, meaning every year you have to pay some tax on it. So that'd be savings accounts, money markets, mutual funds, things like that, brokerage account. And then you got the tax deferred, which is like your 401ks, IRAs. So these are stuff that you don't pay tax on until you take it out. And then lastly, you got tax-free. Tax-free is stuff like Roth IRAs, specially designed life insurance, things like that. So the sad part is, in our live events, usually we bring out the big bucket. And what's the big bucket? It's always tax-deferred. 401ks, IRAs, all right? That's where most people's money is. Usually around 70 to 80% of their money's in there. And they may have 10 or 15% in the taxable. And then we usually bring out it's almost a shot glass, kind of a red Solo cup shot glass. And that is how much most people have in tax-free, which is really sad, right? Because tax-free is obviously by far the best.
Of
and
course.
So one of the things to look at is how can you, before you get to retirement, get more and more money in that tax-free bucket. How can you get that bigger? Because then you get all sorts of control over your taxes. But if you haven't done that, and you haven't done that advanced planning, and you're in retirement, well, now it's okay. How much should I take from which, and what's my tax situation going to look like? Am I going to hit those limits where my Medicare premiums start going up higher? Am I going to cause other things to be taxed? Am I going to hit with the tax torpedo? Only way to do that is you do that planning either at the very end of the year or the beginning of the year to figure out which buckets you're going to take money out of. The problem is, if you try to do that in February and April when you're reporting on your last year's tax return, too late. You already took that money out. And so if you find out that messed you up, there's nothing you can do, right? So really what we need to do is we need to make sure you plan that ahead. And that's the biggest problem. So one of the things we did set up is a lot of information online in our Wealth Creator Toolbox. That Wealth Creator Toolbox has stuff on Social Security. Are you paying too much in taxes in retirement? Will your money last? Finding the right balance, and even some chapters of my book, Worry Less Wealth. You can even set a time to talk if you want to set up a 15 to 30 minute phone call there. So again, if you want to get that Wealth Creator Toolbox, all you have to do, super simple, text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or get it directly at wealthcreatorradio.com.
Eric, tell us how you help people avoid making a misstep with their retirement savings.
Well, I mean, this has been my life's work for the last 30 years is trying to figure out what's the best way to do this. What works, what doesn't work. The biggest thing I've determined is the thing that does not work, and sadly your 401k forces you into this mode, is having 100% of your money in stocks and bonds.
Okay.
It just doesn't work because we all know every decade there's going to be a couple bad years. Now, on average, 2 or 3 of them. So if you're going to be retired, hopefully for 3, maybe even 4 decades, you're going to have a lot of those bad years in there. And with those bad years come, you need to have some stuff that doesn't drop with the market. You need to make sure you have some money that's always going to be there. So first and foremost, you need some foundational money. You need some money that's guaranteed from loss, but still earns some good earnings and still has some good growth. But that money is going to be there for the rest of your life. You can take money out and not have a loss. And there's great insurance products that do that. You could even do it with banks if you want to, but there's some great tools out there that can help you do that. And so in those bad years, like in 2022, that's what we did for a lot of our clients. We started taking money out of those accounts. We did not take it out of the market stuff, so that way it gives the market money time to bounce around and go back up as it does over long periods of time. And then in between that, you want to have some steady income money, some stuff that's very low volatility, but pays really good dividends. Ideally, dividends at least on quarterly, if not monthly basis. And these are things that are not bouncing around, up and down 20% per month or something crazy like that. Mm-hmm. These are very, very stable, very low volatility stuff. And so between having that foundational and steady income money and the market money, I know our planning works. It's worked for the last 30 years for our clients. We've had a lot of clients that have been really, really appreciative that we've been able to be here, help them, guide them to that retirement through it. And things change. I mean, I was just meeting with somebody she's been retired for almost 15 years, and her monthly budget's almost double what it used to be because of inflation. And guess what? My income plan showed that would be the case. So we can go back to that old income plan and say, yeah, this is exactly what we planned for. And so we know it works, but you have to have a plan. And if you're doing this on your own, well, you only get one chance at it, and if you screw it up, it's pretty bad because it's the only chance you get, right, to retire. That's why you want to have somebody here to help you. So again, if you want to get access to some of our great digital tools that we have at the Wealth Creator Toolbox, all you got to do is text the word toolbox to get all those wonderful reports, our copy of our book, and even if you want to set a time, again, text the word toolbox, 800-454-1184. Again, text the word toolbox, 800-454-1184, or book directly online at wealthcreatorradio.com.
Still more to come with Eric Heckman of Heckman Financial. We'll be right back.
Things you can do in 15 minutes. Walk the dog. Make a smoothie. Meditate. Now you can add creating a personalized retirement plan to that list. Schedule your complimentary 15-minute call with Heckman Financial Services today. Text VISIT to 800-454-1184. Keyword. That's VISIT to 800-454-1184.
Welcome back to Wealth Creator Radio. This is Eric Heckman of Heckman Financial. And I've got one of my monthly contributors here, Marilyn Brown-Ross, who is talking about reverse mortgages. And, great to have you here. It's always fun to talk about reverse mortgages and confuse people and tell them what the reality is, right?
Great to be here. And yes, there's a lot of confusion.
Yeah.
We try to clear that up.
Yeah. So one of the problems, too, with a lot of people who are retired right now is they may have been, using their stock dividends or just selling stocks here and there as they needed to get by. And then, of course, 2022 happened, right? And the markets dropped. How can a reverse mortgage help you not lock in those losses by, having to dump stocks because you need to live and get by, right? And pay your mortgage bill?
Right. And I'm dealing with a lot of that right now. I've got a lot of customers calling because they don't want to get rid of their portfolio. They don't want to sell stocks. They don't want to get when the market is down. So what a reverse mortgage will do is tap the equity in the home. It really has had in the past and still has not a good reputation. Let's put it that way.
Right.
But it's so different now. People, once I really explain it to everybody, they go, oh my God, I didn't realize. And this is no taxes. I mean, you can tap the equity in the house and not have any tax consequences, which is huge.
Oh yeah, no, especially now because, if you're somebody who's been around here for a long time, right, and you bought that house for $100,000 or $200,000, and it's worth 1.5, 2 million, 2.5, or whatever.
Right.
If you try to downsize and go someplace, hey, guess what your tax bill is going to be? It might be $500,000, and that's with the $500,000 exclusion on top of that, right? So,
That's right.
Or worse, if you've lost a spouse and stuff, and then you only have the 250 exclusion, not, so you have a little bit less tax benefit. So the reverse mortgage just kind of remind people, there were a couple years back in the 80s where they would share equity. That's way been gone.
For years. That only lasted about not even a year.
Yeah.
But it was so bad that people still remember that. And
Right.
I have to say, oh no, nobody is on your title. When you do a reverse mortgage, nobody's on your title but you. That used to be that the company would go on title with you, and then
Right.
they owned half
They
the
own part
house.
of it, yeah.
They had half your equity, but that doesn't happen anymore. So truly, for the right people, is it right for everybody? No. But boy, for the right person, it's huge, and it's big right now. Even though the interest rates are up a little bit, people just don't want to delve into their stocks and sell the stocks at a loss and have to pay taxes besides.
Yeah, and also maybe they were planning on selling the house or maybe downsizing, and now guess what? Real estate's starting to pull back, and you're not getting those 10 offers. Maybe you get one, or maybe you have to lower your price.
That's right.
So,
Well, most people I talk to, most seniors, I'll ask, that's my first question. Do you want to stay in this home, or are you planning on moving? And if they say, we're thinking of moving in 6 months, most likely. And I'll say, well, let's wait, because it's crazy to go through all of this now, and then you're going to sell now. But I would say 95% say, I'm not leaving this house. They're going to carry me out when I leave because I've been here 50, 60 years and I want to stay here. But I loaned my children money to help them buy a house. And now I lost my spouse or something happens,
right.
and they have a payment to make. They can't make the payment anymore, and they're going to end up going into foreclosure. So the reverse pays it off. And whatever it's based on the age and the value of the property. So it just depends on how much you're going to get.
The age of the person, not the property.
That's right, the age of the person. And they did drop it. In some cases, you can be as young as 55. It's 62, but they did drop it. But it just depends if that makes sense or not. And then a lot of them, I just had a call from a client that's got a nice big portfolio money, and I'm not doing that. I don't owe any money on my house. It was free and clear, but I want to be able to have money to draw on if I need it right away. So he can have a line of credit, and his property was worth a lot of money. So his line of credit's going to be about $700,000.
Wow.
And if he never uses it, he never has to pay it back. I mean, that's just works.
Yeah,
So
but if he needs it, he can
if he
get
needs
a check.
it, that's right. And he said, I can get it and I don't have to worry about selling anything. And that was his reason for doing it. And that's the perfect reason
Yeah.
because it'll work great for him.
I mean, but for a lot of people, you're saying like, they've got that mortgage still maybe, and the mortgage just bounces lower, but they still have, $1,500, $2,000. And that means, especially if you're taking out of IRAs or other stuff, you have to take out more than that money to be able to net the payment to, to that bank. By just as simply just getting rid of that.
It's huge.
Yeah.
And if it's an adjustable rate, the interest rate, and then
Yeah.
their payments are going up. I've had a couple of those calls. Oh my God, my payment went up and I could barely make it when it was what it was. And now that it's higher, I'm struggling. I need to find a way to get this taken care of.
Yeah, well, I find a lot of people when they're retired, they were really big on using home equity line of credits because they would just, hey, we're doing some remodeling, so we'll run it up and we'll pay it back slowly. And, money was cheap, right? 2%, 2.5%, 3%, who cares? And then what?
That's right.
The interest rate's a little different now. It's doubled or even worse. And so those would probably be a lot of people too that, if you're in that boat, this is one way you could just get rid of it and not have to worry about those payments.
Right. And if you do have a line of credit with the bank or the whoever, that's a payment. That's a payment. I've come across several that had lines of credit and the bank froze them. You used it all. Let's say they had a $300,000 line of credit and they've used two. So they were relying on, okay, we've still got that. The bank said, no, that's it. We're not letting you access. Oh, yeah.
Recently?
Yes.
Wow. Yeah. I haven't. Okay. Because that happened a lot in 08, 09.
And it's happening again.
It's happening again because
Yes.
the rates and stuff.
Yep.
So, wow. Yeah. So no, that's something that people really need to be watching for too. Because especially if you're thinking of whatever, you're doing some remodeling halfway through it and all of a sudden they freeze your line, or if you got a car that you ordered and it's almost here and
yes. There's so many things, but it really is. You'd think right now with the uncertain times that it wouldn't be, but reverse mortgage is really. I mean, I got a lot of people calling.
Yeah, and again, I mean, when people really think about this, it's just a way to, I always think it's funny when people say, "Oh, I don't want to have that big mortgage," but you already have if you already owe $200,000 on the house,
right?
You still, if you wanted to go sell the house, you still got to pay that back. There's no difference. Or if you leave it to your kids, they still got to pay it back.
Somebody's going to pay it. That's for sure.
And also now with the more of the reality check of the fact that with Prop 19, most people, inheriting your parents' house, unless it's going to be your primary residence, you only get $1 million of property tax exclusion. And if that thing's worth 2 or 3, you're going to have a huge property tax increase. So more than likely, I'd say most people nowadays, when they inherit houses, aren't going to keep them. They're just going to turn around and sell them. So, sometimes people say, "Oh, I want to have this, this mortgage lower for when they inherit it." Well, now they're not going to do it. They're just going to turn around and sell it because they live someplace else already. And
that's right.
So
a lot of them live someplace else. A lot of children.
And so, so that's the other kind of reality check of, who's going to really get this. And so, if you run up that bill tax-free, it's a great way to go. And then again, like what you said is, you don't have to be selling those stocks when they're down. You can leave that portfolio. You could also be doing other stuff with some of that money, right? I mean, so, there's 2 ways to do it, right? You get a lump sum, or you could either get it all at once, and lots of times that's more for people paying off a mortgage, but you can also do like you said, the credit line, or kind of in between, right?
If you have a mortgage, it has to be paid off.
Right.
So there has to be enough to pay off the mortgage. And then whatever's left, you're eligible for $500,000 or $600,000, and the mortgage is only $200,000. That would give you $300,000 or $400,000 in your line of credit that you can use or not. And it's actually got a growth rate on it. There's so many different programs now. 17 years ago when I started, there was just very minimal, but now there's jumbos, there's HECMs, there's all kinds of things. So, but your mortgage has to be paid off, and then whatever's left you have to use or not use. But while it's sitting in that line of credit, it has a growth rate. So it's actually, and of course we can't say like it's a savings account because there's no interest on it. So it
just allows you to take out more. It allows you to take out more if you need to down the road.
And if you don't, then you don't owe it. So works out well.
Yeah. And so basically when somebody then, if you want to sell the house down the road, or you do what you wanted, right? Get carried out, and whoever else inherits your house, they, just like any mortgage or any loan, that has to get paid off at either sale, or they have to go out and refinance. They would have to with a normal mortgage anyways, because
it's exactly the same.
So no difference there.
No difference.
Yeah. I mean, obviously the only difference is it's a little bit higher balance because you haven't been paying it, but hey,
exactly.
But a lot hopefully the equity shot up or came back or something.
Yeah.
So
most people, the children are doing great, and they go, you know what? I put them through college. I did everything I could for them, and they say, enjoy your life now. You know what? Don't worry about us. We've got whatever's there is there. If it's $100, we're happy. If it's $100,000, it's okay too. But take care of yourself. That's what most children say.
So if people want to reach out and get a hold of you to get some quotes or get some numbers just to see, does this make sense? How would this fit for me? What's the best way to do that?
Just give me a call at 408-722-0010.
Okay, so you can call or text that number, right?
Absolutely.
Yeah, so what's the number again?
408-722-0010.
With that, we'll be right back on Wealth Creator Radio.
Thanks for having me.
Become a wealth creator today. Text VISIT to 800-454-1184 to schedule your 15-minute call with Eric and his team. That's VISIT to 800-454-1184.
Hi, I'm Lou Ann Fulmer here with Eric Heckman, president of Heckman Financial, who is right here in Silicon Valley helping retirees with straightforward advice on how to plan for a secure and a comfortable retirement. Now, Eric, I know that you have been dealing with retirees for the past 30 plus years. And so, every week on our show, we also try to get some input from you, from what you've seen, what you've experienced with your retirees. We often talk about challenges and risks that exist in retirement. And so thought it'd be good today to just have you give us an example of someone who's experienced a retirement obstacle. We call it a financial fail. So tell us about it, please, Eric.
Yeah, well, this is a gentleman who he came to us, and we were trying to help him out. He'd been retired, had to go back to work. He retired early on, and then realized he was, after the fact, spent a lot of money, a lot more money than he planned, because we retired earlier, right? So he had higher medical costs, he had lower Social Security income, all these things. And, now he's trying to rebuild. And, that's really tough to do that after the fact, because he's already locked in this lower Social Security income for life. He's already seen, how expensive things are, but he didn't have a plan to do it in first. And, I see this with a lot of people where they just go off and they don't realize that, they say, oh yeah, you can, you're going to only need X dollars for the rest of your life. Well, you usually have those bucket list items, right? Those fun things, especially during COVID. A lot of people weren't able to do them, so that bucket list kind of got longer because they weren't checking off things, right? And so there's certain things you can do. I mean, obviously having that income plan, knowing what expenses, having somebody review all that's, I think, probably simpler to do, because it's just, hey, sit down with somebody, go through that income plan, and then check on it every year. In retirement too, you can't just
Right.
set it and forget it type of thing. No, you got to check in every year to see how things have changed and see how things are. There's one theoretical thing of how much I was going to spend. Well, here's how much money I have left, and did you spend that much or more? So those are the things that you really want to be looking at. And then also, for anytime you have any large dollar amount in something, if it's a stock or whatever, you can put usually stop losses on that. You can have things where they sell at a certain level and bail out. So, again, have a plan is where this all sadly comes down to. I know it's boring, but that's what it's all about.
But it's the truth, yeah.
So, if you need to get some more resources, you want to get a little bit more information, you want to educate yourself, you can get my book, you can get a lot of great white papers about Social Security, how not to run out of money, all these wonderful tools that we have built up at the Wealth Creator Toolbox. All you have to do is text the word toolbox to 800-454-1184. Again, text toolbox 800-454-1184, or download it directly at wealthcreatorradio.com. That's all for this week's show. Thanks for listening. Talk to you next week.
Information provided during Wealth Creator Radio is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Individuals should thoroughly review the contract for specific details of the product features and costs. Income payments and withdrawals from deferred annuities are generally taxable as ordinary income in the year they are taken. Eric Heckman offers investment advisory services through Heckman Financial and Insurance Services, Inc., a registered investment advisor. Any tax advice given as part of this presentation is not intended to be used and cannot be used by the taxpayer for the purpose of avoiding tax penalties or promoting, marketing, or recommending to another party any matter or transaction addressed herein. The views and opinions expressed in the program are not necessarily those of the radio station or its sponsors, and they should not construe as legal, tax, or investment advice. You should always consult the appropriate advisor before making any financial decision.